Yeah, I forgot to put up the recording from Tuesday's class, so I apologize for that. So looking at what we went through on the chapter 8, the beginning of chapter 8. I'm sorry, my husband's having to scan and do some things for my son. There he is waving at y'all. Come, handsome, come read, come introduce yourself. This is handsome husband.
This is working from home.
This is working from home. These are my principal students. Look, y'all didn't know I was married to a long-haired hippie man.
Okay.
Yeah, this is the man who hitchhiked to Woodstock. What can I say, you know? All right, handsome. So, bye. Okay. So, anyway, okay, so looking at what we did discuss on Tuesday with respect to the current liabilities, the payroll and the 3 journal entries that we have with payroll. One, what are the 3? 1, record the payroll. What was the second one?
Record the fringe benefits.
Okay, good. Record the fringe benefits. And then the third one was?
Record the taxes.
Good. Record the taxes. Now, what are included in payroll taxes?
Unemployment and FICA.
Good. The FICA match, and I didn't hear what you said.
Unemployment.
Good. And unemployment, right? Those are the 2 that are considered payroll tax expense. We also looked at sales tax. You know, the portion of the sale that is for sales tax goes into a liability, and then it just gets remitted to the county. Now, we did interest, and y'all have done interest before. You've calculated interest. You know the journal entries. Record the note payable, accrue the interest, and then pay the note payable. And we worked a problem with respect to that. One of the things, because I get so nervous about making sure that y'all know how to calculate interest, that I just drill it. So I'm going to go ahead and pop up a polling question. And a lot of these polling questions just sitting for attendance, but it's learning. And so I'm going to pop up a question just so that we can, oh my gosh, no wonder. All right, well, I was wondering, because the polling questions that I had were in another meeting, and so I didn't add them to this meeting. And oh, that aggravates me. I put them in the wrong meeting. I put them in y'all's class, but for the meeting that is later on. It's just making sure that y'all know how to calculate interest. Darn it. Man, and I just spent so much time uploading about 7 questions I wanted to ask y'all. I will send them. I tell you what I'll do. Here, where there's a, let me, all right, I'm going to share screen right now. And I want you to answer this question. So we'll do it on a share screen.
Should we type our answers into the chat?
Well, let's just talk about it. Okay, so do y'all see that?
Yep.
All right. So go ahead and calculate it, and I want everybody doing it and participating. I'm gonna be taking notes when I come back from sharing screen as to who's sitting there waiting on others. got it? All right, I'm going to let's stop sharing the screen.
Is it D?
No,
Oh,
that's all right. No, Jay, look, if we don't try, we don't know. So when was the note taken out?
November 1st.
Okay, November 1st of what year?
21,
21. Now, and when did the note mature?
22, in
Right, and what day in
May-
22?
May 1st,
May 1st, all right? And the question asked what was interest expense for which year?
22,
22, right? So it was a 6-month note. How many months of the 6 months was in 2021?
2,
2. How many months were in 2022?
4,
4. So how much interest expense would we have in 2022?
4,000,
Good, 4,000, good. It was, Jay, the 6,000 is the total amount of interest that will be paid, but 2,000 of interest expense in 2021 and 4,000 of interest expense in 2022. So actually what I'll do is I'll go back to sharing the screen and we'll take a look at all the journal entries that we would do on this note. Okay, so I'm going to go back into share screen. And the journal entries that we would do would be on, let me do this. The answer is B, as we know. But on November 1st, what would I debit?
notes payable,
Um,
no,
how do we increase, notes payable is what kind of an account?
oh, I'm sorry, they borrowed it, cash.
Right, so
Notes
they borrowed,
payable.
good. So we will debit cash for 100,000 and credit what?
Notes
A
payable.
notes payable,
Good, notes payable for 100,000. Now on December 31st of 2021, this was on, who's got the background noise if they could?
that's me, I'm sorry.
That's all right. I understand. Like I said, I had my husband in here earlier. All right, so on December 31st, what journal entry or adjusting journal entry would we have to do?
interest expense.
Okay, good. Interest expense for how much?
2,000,
Nice job. 2,000. And then we would credit,
interest payable,
good. See, y'all know this, for 2,000. Now on May 1st of 2022, when I pay it, what would my journal entry be?
you would debit notes payable for
Debit note
100,000,
payable for 100,000. I would debit,
interest payable
good, for
2,000,
2,000, perfect.
and then debit interest expense for 4,000.
Cool, and then
Credit cash for 106,000.
nice job. And then we would credit cash for 106,000. Okay, so this is where we get the interest expense of 4,000 in 2022, interest expense of 2,000 in 2021, but we're actually paying the interest expense in 2022. So nice job on that. here is you see the answer, but here is one where I wanted you to see a question with respect to Social Security tax and Medicare tax. You only have, and unemployment tax too. You only have to, there is a maximum that once your salary gets up to a certain amount, then you don't have to pay the tax anymore. And in this example that we see here, that Social Security, the maximum base that you have to pay Social Security tax on is $128,400. That may be the current max now, or maybe that was last year's current max. But anyway, you only have to pay Social Security tax up until your wages meet a certain maximum base. And in this case, it was $128,400. So if the coach earns $2.4 million a year, that's their base salary. That doesn't include all the other stuff, right? And I guarantee you, they don't coach for LSU. LSU pays a whole lot more than that. But anyway, a coach's salary, how much is well, answer the question. And then after you answer the question, I want you to calculate how much Social Security and Medicare tax would be withheld from assuming that wages are paid once a month. How much Social Security tax would be withheld from the check, and how much Medicare tax would be withheld? And these are the current rates. That's where that 7.65 comes from, is 6.2% goes to Social Security and 1.45% goes to Medicare. So that 7.65% that we talked about. So how much does the coach earn a month?
$200,000.
200,000, good. So then what is the question here? Through what month will they have to withhold Social Security tax? When would the coach reach the maximum on Social Security?
Would it just be at the end of January?
Right, in January. Okay. January is $200,000. So obviously in January, if the maximum amount that you hold Social Security on is up to a base of 128,400, the coach will reach his Social Security max in January. And then the rest of the year, he would not have, or he or she would not have Social Security taken out of their check. Always look forward to when that happens for me. But mine doesn't happen in January. It's like I got a raise when I reach my Social Security max, and they no longer withhold money out of my account. I mean, out of my check, because I've reached my max. But how much Social Security would be withheld from the coaches? So how much would be withheld from his check in January or her check?
$162,800.
How did you get that number?
I just added the 128,000 and then I multiplied the salary by 1.45.
Okay, so you're including the Medicare.
Yeah.
Okay, gotcha. So the Social Security would be 128,400 times the 0.062, and that equals, I got 7960.80. Is that correct?
Yep.
And then the Medicare would be, since there is no maximum base, would be the 200,000 times the 0.0145. Peter, that's how you got the,
Yeah.
which is 2,900. So you sum up those, and the 2,900 plus the 7960.80, and did you get 10,860.80, Peter?
Yeah, I'm just adding it up now.
So that would be the amount of FICA. FICA is the combination of Social Security and Medicare. So the amount of FICA that would be withheld would be a total of $10,860.80. Now, what would be the employer's payroll expense? Would the employer have a payroll tax expense? Sorry, I don't know where that went. Would the employer have a payroll tax expense?
Yes.
Yes, because we just talked about what makes up payroll tax expense for the employer?
FICA and unemployment.
Good, the FICA match and the unemployment. Now, we don't have the unemployment information here, but 10,860.80 would be withheld from the coach's paycheck. Then remember that the company would have to match dollar for dollar. So 10,860.80 would be withheld from the paycheck of the coach. Then the employer would have to have payroll tax expense of the same amount because of that dollar for dollar match requirement. So the amount that would be, so let's say this was a college, since it was a college coach, the college would remit, and remit means pay, $721.60 to the Social Security office, and 10,860.80 would be payroll tax expense. Does that make sense? Was everybody able to get the numbers?
Yep.
All right. Here's another one. I'm gonna go ahead and show you the answer and the explanation on this. where, you know, you've got 10 workers. This is asking, what is payroll tax expense? As we've just said, payroll tax expense is the FICA match and unemployment. So we see if you do 40 times 10 times 20, you should get the $8,000, right? We had 10 employees working 40 hours a week at $20 an hour. So that means that my gross payroll is 8,000. So I multiply the 8,000 by the 7.65%, and then multiply the 8,000 by the 3.5% of unemployment, so that we know that our payroll tax expense is the sum of the two, because as we have already said a couple of times, that payroll tax expense is the employer's FICA match and federal and state unemployment. Okay? All right, I'm gonna stop sharing and come back to y'all. All right, so you feel comfortable about what we had discussed with payroll, sales tax, notes payable, gift cards. We'd also talked about gift cards as deferred revenue. On page, to finish up the chapter, yeah, the gift cards, and we talked about the gift card breakage. That was on page 407. And we talked about current portion of long-term debt. So where we're going to finish the chapter today is on page 410, which has to do with contingent liabilities. GAAP says that if it's probable is the term that is used. If it is probable that we are going to incur a liability and the amount can be estimated, then we must accrue that liability. Remember, accrue means that we need to do the journal entry recognizing the liability. If you look at the illustration on page 410, illustration 8.7, there's the table that tells us how we handle the different types of contingent liabilities that we could have. A very common one is litigation. Companies get sued all the time. And so how do we know that if a company gets sued, whether we should recognize the liability? Should we disclose it? Should we ignore it? I mean, what do we do when a company has been sued? Well, first you got to contact their attorney, and this is something that's just done annually when companies undergo audits, and that the attorneys have to opine on whether they believe that, yes, it's probable that we're going to lose the suit, maybe we'll lose the suit, not probable, but it's not remote. So probable, reasonably possible, or remote are the ways that contingent liabilities can be categorized. And GAAP says that if it is probable and the amount can be reasonably estimated, that we have to look at the illustration on 8.8. So you got the definitions on illustration 8.7. If you look at illustration 8.8 on page 411, it tells you how you handle the likelihoods. So if it is probable and can be reasonably estimated, we have to record that liability. We have to accrue it. if it is probable, but we have no earthly idea how much it's going to be. In other words, we can't reasonably estimate the amount, then we don't accrue a liability. We just have to disclose it in the disclosure notes. If it is reasonable.
Sorry, I can't help you with notes on app.
Siri was trying to read me. Siri thought I was talking to her. If it is reasonably possible, then we just have to disclose the situation in the disclosure notes to the financial statements. Now, what do I mean by disclosure notes?
2:30 p.m.
Sorry, my watch is talking to me. So what do I mean by disclosure notes? What are disclosure notes? We hadn't talked about that. Something that we just kind of assume. When you look at the financial statements of any company, in addition to the financial statements, the income statement, the statement of stockholders' equity, the balance sheet, and the statement of cash flows, behind the notes, behind the financial statements are disclosure notes, pages of information that explains numbers that are on the financial statements. So within those disclosure notes, contingent liabilities would have to be disclosed, where you give a brief description of what's going on. Of course, you're not going to give away any proprietary information, but you would just disclose, hey, we have litigation going on. We don't think that we're going to lose it, but if we do, this could be the range of amounts. Okay. Now, obviously, if it's remote, then we're not going to do anything. Remote meaning we don't think that we're going to lose the case at all. Now, always as an auditor, found this very interesting, because we have to get, as when I was an auditor, you have to get a list of all the litigation that is filed against the company that you're auditing, to see if there are any contingent liabilities that need to be accrued. Okay, and then you send the information to the attorneys, to the company's attorneys, and the attorneys have to come back and provide the information. The American Bar Association is familiar with this terminology, very familiar with it. And they have to come back and assess whether it is probable, reasonably possible, or remote as to whether they're going to lose the case. Now, any of y'all have parents or family members that are attorneys? Come on, go ahead and own it. Own it. Well, how many attorneys do you know are going to say, hell yeah, we're going to lose this case? I mean, come on, right? They're not. So, you know, this gets to be a situation where, I mean, they could be in the last days of trial. They could have already been, the jurors came back and said, you lost the case. And they're going to say, no, we're not going to lose it because we're going to appeal it. It's real interesting dynamic. But anyway, those are the rules. The reason that I find this so interesting is, you know, in order to get your PhD, you have to write a dissertation, you know, like this thick. And my dissertation was on contingent liabilities. So I know quite a bit about contingent liabilities. So that is the rules on contingent liabilities. Now, in addition to litigation, another contingent liability, if you look on page 412, that many companies have is warranties. You think of anything that you buy, and there's a warranty on it, whether it's an implied warranty or an extended warranty that you buy. But like my husband bought a car, as y'all know, 2 weeks ago, because I thought we were crazy going out and the virus and buying a car. So my husband bought a car 2 weeks ago. And of course, the manufacturer, he bought an Infiniti. The Infiniti has a warranty on my husband's car. And as soon as he drove that car off the lot, then Infinity had a contingent liability on that car, that they have a warranty. Because is it probable, I'm sorry, he's having to take care of some business in the printer and scanners in here, but companies know that it is probable that they're going to have warranty expense. They know that it doesn't matter what the dealership is, that some cars are going to have warranty expense. So they don't know particularly which car is going to have warranty expense. But based on history, they know what percentage of their sales or of their units, depending on how they define it, will have warranty expense. So they're going to have to recognize the warranty expense in the year that the sales are, although it may be a year or two down the line before that car actually comes in for a warranty claim. So this is a contingent liability, but it is one where we have to record a liability because it meets the definition of probable, and the amount can be reasonably estimated because the company has history on it. So let's take a look at, I assume y'all read this and did your smart book. Let's look at exercise 815. And exercise 815 is on page 428. So let's look at exercise 815 on page 428. Now, what I'm going to do is I'm going to pull up Excel, and I'm going to pull up a blank Excel sheet, and then I'm going to share the screen, and we're going to work this problem together so that you understand both the warranty expense and the warranty liability. Okay? So let me pull up a blank Excel page. And now I'm going to join you again, and I'm going to go into share screen, and you should see a blank Excel file. So we've got an appliance company that began operations in 2021 and offers a 1-year warranty on all the products that are sold. Their appliance sales in 2021 are $1.6 million. So their sales were $1.6 million. And they estimate that warranty expense will be 2% of their sales. So these were sales in 2021. So my warranty expense for 2021 will be equal to the sales times 2%. So they expect that their warranty expense for the year 2021 will be $32,000. So the company will do a journal entry where they debit warranty expense for the $32,000. And what account do you think they will credit?
Warranty liability.
Good. Warranty liability, because they owe it, or this is the estimated amount that they owe. Now it says actual warranty cost, offers products 21 and estimates. Okay, so they estimated that 2% of current sales, but they estimated, remember that they have a 1-year warranty, so they estimated that the warranty would be in 2022. So this journal entry that we just did, sorry, would be as of December 31st, 2021, because this is the expense related to the 2021 sales. Although they're not anticipating that the products are going to come in for warranty servicing until 2022, we have to accrue the expense. Boy, did I misspell that, huh? Well, y'all get the picture. Okay. That they have to have the expense in the same year as the sales. Now, in 2022, actual warranty costs were $25,000. All right. So in 2022, so we're just call this a summary entry because it wasn't on any particular day, but during 2022, the total of the warranty that was claimed for sales in 2021 was $25,000. So in 2022, we would debit the warranty liability for $25,000 and then credit, cash, or whatever it was on how they paid their warranty. Okay. So this is the actual warranty cost that they had in 2022, but on the 2021 sales. Then in 2022, so they overestimated the amount that they expected. They expected warranty to be $32,000. It was only $25,000. So with respect to the 2021 sales, what is the balance in the warranty liability account? Well, how much did I put into it?
It's gonna be seven.
Good, it'll be 7,000. I put 32,000 into it and I debited it for the 25,000 of actual warranty. So we've got a balance in warranty liability right now of 7,000. They overestimated because this was their first year. And so then in 2022, they had sales in 2022 of 2.4 million. But now they estimated that their warranty expense they revised their estimate from 2% to 1.5%. Okay, so they revised their estimate from 2% to 1.5% because they saw that their 2021 expenses, warranty expenses, were lower than what they had estimated. Oh, this is so aggravating. All right. So they're estimating that their warranty expense, that their warranty liability, let me phrase it this way, for for 2022 will be the sales times 1.5%. So they estimate that the warranty liability should be $36,000 for their 2022 sales. That will be actually the 2022 sales that the warranties will come in 2023, because they have a 1-year warranty. Some would come in 2022, but they're just trying to keep this clean. This is in Excel. So I'm going to merge and center, and I'm going to do warranty liability. And I'm going to underline it. And we had a debit of we had a credit of 32,000. We had a debit of 25,000, which is where we got the $7,000. So I'll draw a line under there. It's just doing it under the 25,000, but we had a $7,000 balance. So this would be the unadjusted balance as of 12/31/2022. Now we estimate that the adjusted balance of the warranty liability account should be $36,000. Because now the 1-year warranty period has expired, so nobody can bring back anything from 2021 for warranty because the warranty has expired. So 2022, I'm saying that my warranty liability is $36,000. So I want the adjusted balance as of 12/31/2022. I want it to be $36,000. So what am I going to have to do? What adjusting entry would I have to do at December 31st, 2022? So my unadjusted balance is $7,000 because this was the amount that we had overestimated in 2021. My warranty liability, I'm saying now should be a $36,000 based on 1.5% of the sales in 2022. So what is it going to take to get a $7,000 unadjusted balance to a $36,000 adjusted balance?
29,000.
Good. I'm going to need to credit it for 29,000. So my adjusting entry at December 31st, 2022 would be to debit warranty expense for 29,000 and credit the warranty liability for 29,000. So I end up with my warranty expense for 2022 is $7,000 lower than what I expected my warranty expense to be just on my 2022 sales. But my warranty expense is $7,000 lower because I had overestimated it in 2021. And now I have adjusted it to what it should be. How are we doing with this? It's really easy. Am I making it dollars? Oh, I stopped sharing somehow. Are y'all see me or the Excel?
We see you now, but it
Okay.
like blacked out.
It did, yeah, but I don't know what happened. Uh, so I'm gonna share screen, and there we go. All right, so we had estimated that in 2021, we had warranty expense of $32,000. In 2022, we had warranty expense of $29,000, although we estimated that our liability for 2022 would be $36,000. So that means that we want the adjusted balance of our warranty liability to be $36,000, but because we had overestimated our warranties in 2021, our warranty expense in 2022 is going to be lower. Okay? I'm going to stop sharing, and I'm going to pull up a question about warranties. All right, so now I'm gonna share screen again. And I believe that's it. You'll see the answer, but let's determine how we got $7,000. So here we've got a company that sells soccer goals, and history shows that 2% of the goals will need repair. They sold 4,000 goals, and 45 have been repaired. If the estimated cost to repair a goal is $200, what would the warranty liability be at the end of the year? Well, if I take, they sold 4,000 goals, and they estimate that 2% of them will need warranty repair. So what is 4,000 times 2%?
80.
How much?
80.
80. So they expect 80 goals will come back for repair. Now, how many did they actually repair?
45.
45. So 45 goals were repaired. So how many goals are left to be repaired?
35.
So 35 are left to be repaired. Now, what does it cost to, I'm sorry about that noise, but he's doing something that has to get done now. And so 35 are left to be repaired. And what is the cost of the average repair?
200.
So, right, so times the $200, and what is 35 times $200?
7,000.
7,000.
7,000, good. So that is because it asked the question, what is the balance of your warranty liability? What if it asked, what is the balance of warranty expense for the year? What would the answer be if warranty, if they asked, what is the warranty expense at the end of the year? What would your answer be? So what would warranty expense be for the year?
$9,000.
I didn't understand.
9,000.
9,000, how did you get the 9,000? That's the 45 times the 200.
Yeah.
Right. So how many goals did they expect that they would have to repair eventually?
80.
Whether it's this year or next year? 80. So the warranty expense is the 80 goals times the 200, which is 16,000. So what would happen would be this. At December 31st of, they didn't say what year it was, but let's say they sell soccer goals in 2021. And they anticipate the remaining 35 goals will be, so 45 will have been repaired in 2021, and then the remaining will be repaired in the ensuing year. Okay. So at December 31st, 2021, the company would debit warranty expense for 16,000 and credit warranty liability of 16,000. Then during 2021, when they actually repaired 45 goals, the journal entry that they would have done would have been to debit warranty liability for, what is 45 times 200?
9,000.
45 times 2.
9,000.
9,000. And then, credit cash or however they paid for the warranties. So what would be, so we debited warranty, we credited warranty liability for 16,000. We debited warranty liability for 9,000. So what is the ending balance at December 31st of warranty liability?
7,000.
7,000. So you see where that 7,000 came from? It's the 35 left times the 200. You can also look at these journal entries that were done where warranty expense is 16,000, which is the 80 goals times the 200. So warranty expense is 16. They actually repaired 45. And when they repaired the 45, they reduced their liability. And so now the remaining liability for these goals is that 7,000. So the balance of the warranty liability is 7,000, but warranty expense was 16,000. Okay? Does this make sense?
Yes.
All right, I am going to go back into and I am I'm joining y'all, or maybe I had already joined y'all. Does anybody have any questions about anything in Chapter 8? We have covered all of the topics in Chapter 8. We worked several exercises on Tuesday. Those that weren't in class on Tuesday, I will put the recording up. I forgot to put the recording up. The remainder of what we had today, we have just covered. So take a deep breath, because Chapter 8 is a breather for y'all right now, because you can see Chapter 8 is building off concepts that you've already learned. It's just talking about some specific types of current liabilities that a company can have. The two that you haven't, payroll, warranty, and contingent liabilities, are two that you've not seen, but certainly can see how we're applying the concepts that you already know. Okay, Chapter 9. Chapter 9, excuse the language that I'm about to use, but Chapter 9 is a bitch. I said it. I really did. Owning it. Chapter 9 is about long-term liabilities. And there are several difficult topics in Chapter 9. So take Chapter 8 and enjoy it. Over the weekend, study Chapter 9. Study it. We're going to first, on Tuesday, we're going to cover time value of money, which is Appendix C. So we're going to do Appendix C first, which is time value of money. After we talk about time value of money, then we're going to get into Chapter 9, and we're going to learn one of the long-term liabilities that companies have are bonds. We're going to learn how to calculate the selling price of a bond given certain market conditions. We're going to learn how to record the issuance of bonds. And we're going to learn how to calculate the interest expense on bonds, along with I'm going to use some words here that you've not heard of before, but I'd like for you to know them by Tuesday. Amortization of a premium or a discount. In your textbook, on page 452 is an amortization schedule. You can just write these numbers down. But on page 452 is the amortization schedule for when a bond is issued at a discount. On page 453 is the amortization schedule of a bond when it is issued at a premium. And we're going to work through all of that number crunching, because you have to know how to prepare an amortization schedule in order to know the journal entries that need to be done on bonds. Okay? So although on Tuesday, we're going to spend half the class period learning time value of money, the second half is going to be learning about bonds. On Thursday, we will continue learning about bonds. We will not be able to wrap it up in a half a class. On Thursday, we will continue learning about bonds, as well as tackling the long-term notes on and installment notes that are on page 443. Okay. So I'm asking you, I'm glad that Chapter 8 was a breather. Chapter 9, embrace it over this weekend or before Tuesday. Read it, do your smart book, take some of the exercises, not problems, problems are harder, but take a couple of exercises and just practice it. It's exercises that I've got the solution opened up, uploaded for. Practice them, do some exercises so that when I start talking about it, you have a clue as to what I'm talking about, that you're not seeing it for the first time, that you have actually practiced it. It will make the learning curve, instead of it being a very steep learning curve, it will flatten it a little bit. I guess we shouldn't talk about curves when we want our virus curve flattened, right? We're talking about a learning curve right now. So embrace that for me for chapter 9. And then chapter 9 will go a little smoother if you've exposed yourself to it before we get to that on Tuesday, okay? And understand that time value of money. I'm gonna pull up a polling question right now. And I'm going to launch a polling question, and I need for you to answer it, please. Let's see how many of you really are here. Okay, does it surprise you that not everyone answered it? How many are logged in and just don't show their face and make me think they're there? All righty, I shall know. Got it in at the last minute. All right, so y'all all answered it. The person that I was waiting on answered it at the last minute. So y'all have a great weekend. Like I said, enjoy the ease of chapter 8, and let's get ready for time value of money and bonds on Tuesday. I will upload into course content information, in-class problem that we will do. Instead of doing an end of chapter problem, so I leave those for y'all to have for practice, I will actually write our own in-class problem that we will work, and I will upload it so it's available to you on Tuesday. Okay? Does anybody have any questions? Does anybody have any questions about the SU option that you have? Because I have the answers.
Can we pick and choose like which classes we want to do it for, or is it either like our whole schedule?
No, you can pick and choose which class.
Okay.
Okay, you can pick and choose which class. Also, you know that registration for the fall begins when?
April 6th.
Good, April 6th. Remember, you have to be cleared for registration by your advisor. So if your advisor should have reached out to you by now, if they have not, you reach out to them, because they have to clear you. You won't be able to register if you're not cleared for registration. So you should be meeting with your advisor and making sure that you're good with the classes that you want to register for the fall, that they're in agreement with that, giving you the proper guidance, and so that you're ready to go on the 6th and can't register because you haven't been cleared. Have y'all heard from y'all's advisors?
Yes.
Okay, I know that I've sent out an email to all of my advisees. So for those of you that said no, reach out to your advisor. You can look in, well, not Spartan Workday. You can look at Workday to see who your advisor is and send them an email about being cleared for registration. Because you don't want to be stuck on April 6th and not be able to register because you haven't been cleared for registration. Okay? And if I can help you in any way, if any of y'all are accounting majors, how many of you are accounting majors? Okay. If you've got any questions, reach out to your advisor. But if I can help in any way, just let me know, because I know accounting majors' schedules really well. And if I can help any of you in any way, including convincing you to be an accounting major. Right? All right. Peace out. Make sure you contact your advisors. I want to make sure that y'all are good on that. And I will see y'all on Tuesday. Have a great weekend. And I will upload the recordings for y'all.
All righty.
Okay?
Thank you.
Bye-bye. You're welcome. Now,
Dr.
enjoy us getting out early because it doesn't happen too much. For sure won't happen in chapter 9. Bye-bye.
Bye. Dr. Bostic,
Yes.
do you think it's better to take intermediate accounting like right after you take financial accounting, or should I take managerial accounting?
A lot of students take managerial. To answer your question is you are capable from a knowledge standpoint of handling intermediate after 202.
Okay.
The only thing is I teach intermediate, and it is a difficult class. So make sure that you've got often if you're a second semester freshman or first semester sophomore, it depends on you and your personality and your discipline. Because I find that students, if they get into intermediate too early, if they don't have the discipline for studying and being able to critically think, they have a harder time. So
Okay.
it's not necessarily that it's from information in 203 that you need, it's more the maturity you need of another semester. Now,
Okay.
I know John's on here listening to our conversation, but Peter, you seem to have the maturity and the discipline to be able to handle it,
Gotcha.
to go on to intermediate.
Yeah.
There's also Professor Goodwin. Oh, I forgot in the fall, I'm only teaching one I normally teach all the day sections, but there was a scheduling conflict. So there's a Professor Goodwin and I are teaching the 2 day sections. There's a night section, but you do not want to take intermediate at night.
Okay. Yeah.
You do
Probably
not want to take intermediate night. So either with me or Professor Goodwin, he's just starting to teach intermediate. I teach it at, I don't remember, it may be 8 o'clock in the morning. So if you don't want an 8 o'clock class, then you might be with Goodwin. But come join me at 8. We have a lot of fun.
Yeah, definitely. No, I'm definitely thinking about it for finance. I think it would really benefit me to take it.
Not really benefit, Peter. For finance, I highly, and even the finance majors, professors do, that intermediate is the best elective that you can take out of a list of electives. I've had so many finance majors that took intermediate with me, and or not just with me, took intermediate and said, one of the things about